We have a cut of around 141 points on the Hang Seng, which has cut the US long-term credit rating to AA+ from the previous AAA rating.
The sources suggest that the agenda primarily involves only online gaming.
Supports come in at the 20-day moving average, which comes in at 19,616.
Q1 typically year-on-year is a low quarter.
Our objective of being number one in SUVs.
60 down at the start, that's what the Nifty is giving.
We think the entire residential property market currently is booming.
We are confident that the cost of funds would hold up and NIMs will improve.
Content is what makes any cinema work.
I would expect, the response to be much muted this time.
And it's a big down day for our market.
Tata Chemicals, of course, is lower in trade after cutting their domestic soda ash price.
And I'm standing here in front of the two shops that were totally set ablaze by a mob yesterday.
Market continues to slip. We have Nifty sitting with cuts of 250 points.
That was the day so far. Hello and welcome to Closing Bell, live from the CNBC TV18 Motilal Oswal studio. I'm Reema Tendulkar, with me Surbhi Upadhyay, and we've got Nigel D'Souza in the newsroom. And that 250-point cut has now become a 300-point cut now on the Nifty, with the Sensex lower by 700 points. You know that phrase that when US catches a cold, the rest of the world sneezes? Today pretty much epitomizes that. Look at the way we've seen the fall, not just in the Indian markets, but across global markets. In the Asian market basket, you've got Hang Seng down close to about 2.5%. You had the Nikkei index down 2.3%. If you pull up the European indices right now, it's 1.5% straight away gone from the benchmark indices there, the CAC, DAX, and the FTSE. So it's that downgrade by Fitch for the US sovereign rating, which has really shaken up sentiment, resulting in a lot of profit booking across global markets right now. 19,450 on the Nifty. Just 4 Nifty stocks out of the 50 stocks are currently in the green, and not even one stock is holding up with a gain of more than 1%. That's the extent of the fall. The top losers include Hero MotoCorp, Tata Steel, Tata Motors, Eicher Motors, so across sectors, but the ones which are leveraged to the commodity cycle, the ones which have global exposure, they're the ones reeling under pressure today. The Nifty Bank is currently down close to about 800 odd points, and the support for that is going to be closer to that 50-day moving average. So let's just get that up for you on your screen. The 50-day moving average for the Nifty Bank stands at 44,598. So we are currently above 200 points above that level, but we're going to be watching that support very, very closely.
And what really stands out for me, Reema, today is that the approach the market has taken to this event, no one's rushing in to buy, at least not right now. This whole thought process seems to indicate that people wanted to settle and they want to see some sign of stability in global markets before perhaps, dipping their feet in right now. So the last time we were at these kind of levels, it was not too far ago, actually. Just about 13th of July is when the Nifty was around the zone of 19,450 thereabouts. From the top, we've only lost 2.7%. Yes, on the screen, a 300-point cut looks really bad. But in the relative scheme of things, maybe it isn't such a bad drill. The question really is, at what point do buyers come in? And buyers aren't coming in anywhere. Nigel, the other thing that I'm looking at is the way the banks are performing. The Bank Nifty is hardly a contributor when the market's moving up these days, but it's definitely a major reason now why we are down, because in terms of the pressure, that one's falling even more than the Nifty. So interesting setup right now. There's a complete buyer's strike. Let's see, 1 more hour to go.
Well, Surbhi, you hit the nail on the head, because the Nifty Bank, if something had to turn around, it had to be the Nifty Bank. In the first few minutes itself, it was trading below the 20-day MA, and you would have liked the Nifty Bank to fight back towards the 20-day MA. That didn't happen, and that's putting pressure on the index itself. Just take a look at the Nifty, though. The PCR, which we normally track, it's been in that broad range for the last year or couple of years, between 0.6 to around 1.6. Now, it's at the lower end of the range. Currently, it's sub 0.65 odd. That's telling you the call writers, well, they are writing very, very aggressively. And we have call writing at around the 19,600 call as well as the 19,500 call. So the call writers, after a while, they are feeling very, very confident. You have a surge in open interest out there, and the premiums getting eaten into. And just take a look at the out-of-the-money put buying that we're seeing today. The 19,350 put, at the start of today, the premium was around 2 rupees, or end of yesterday, it was around 2 rupees 50 paise. That's moved to around 30 rupees as we speak. So the out-of-the-money put buyers, well, they are feeling very, very happy, while the call writers as well have come in there, and they are writing aggressively. Just keep an eye out on the PCR. Normally, we see a bit of a bounce when it goes to around 0.6 odd. As of now, it's at around 0.63 the last time I checked. So that'll be one of the crucial factors that we should be tracking. But clearly, no bounce is what we have seen in today's session so far. Well, I think let's get in a couple of technical strategies then. How do you position yourself for today's trading hour? We have Mitesh Thakur who joins us. Hi Mitesh, good afternoon. Well, it's been a session to the bears. The bulls have been absolutely knocked out. What's your reading?
In fact, I was looking at some kind of correction. We talked about buying into put options into the Nifty. But it's kind of exceeded the target which I was looking at. I was looking at 19,450 to come in and place a strong support level. We did dip below that. But now I think we are reaching an area where multiple supports will kick in. First, around 19,375 is an important weekly average. And then below that, 19,200 is a weekly gap level. So I think these are the two levels to watch out for. In case you see a break below 19,375, I would at least pencil in a test of 19,200. But what we have done is taken profits of the put options positions. We want to now sell on a bounce back because we're getting closer to the support areas. So the idea is very clear. Try to sell closer to about 19,550, 19,600 and take a stop just about 19,650. Today's gap becomes an important marker in that sense. And the gap down there was no attempt after the gap down to fill that gap. Typically what is happening is that last few days when there was a gap down, you will see a rally in the first hour and the gap got filled. And therefore the selling never materialized strongly. But I think today is slightly different in that sense. So slightly on the cautious side, while you've taken profits on the put options position, the overall outlook is slightly on the negative side. But on the index per se, as I said, now would want to sell on a bounce back. On the stock side, ABB is something which after a good rally and a strong move for many months now is showing first signs of profit booking. So that's a sell with a stop at 44.50. Look for targets of around 4,200 here. And SBI Life is also giving some negative crossovers. So would recommend a sell here with the stop just above levels of 12.78 for targets of 12.30.
Okay, thank you very much for that. But let's get to the big story, the top story today, and that is the Fitch downgrade of the US sovereign rating. Prashant is now at the big wall, and he's going to take us through what happens when some event like this happens. Prashant, we've only got one precedent in the past, right? In 2011.
Well, no, that's absolutely right. As they say, the future is unknowable. All we can do is look at the past and try and decipher what happened on a certain given event and what were the effects, etc. And that is essentially what I'm trying to do here, not prophesize what lies ahead, but just look at the evidence because this has happened once before, right? Now, before we talk about what happened after the event, we have to look at what was the positioning like going into the event. So what I've done is I've just looked at, the S&P and the S&P downgrade in 2011, the Fitch downgrade, which is right now. This is 2011, that is 2023, the current one. And I have basically looked at what the Nifty, the S&P 500, the Nasdaq have done going into the event, right? So very eerily similar. The S&P downgrade in 2011 happened on the 5th of August, and this has happened on August 1st, right? So August seems to be the month of downgrades. Going into the event back then in 2011, that is December 31st, 2010 to August 5th, 2011. Actually, this is till August 4th because 5th the downgrade happened. Nifty was down 13% already before the event, right? The S&P 500 was down 4.6%. The Nasdaq was down about 3.6% or so. This year, it's completely different. Coming into this downgrade, the Nifty actually is up 9%. The S&P 500 is up 19%. And you've got the Nasdaq, which is actually up some 37% or so. So the market was weak coming into the 2011 downgrade by S&P. The market is super strong coming into the Fitch downgrade in 2023. Now let's look at what happened back in 2011. Right? So this is the same. These are the same figures. The first column, what markets going into the S&P downgrade. But after the event on the 5th of August, what did the markets do over the next 1 month? Actually, it's not exactly 1 month. It's the next low, basically. But it's coinciding between 25 and 30 days after the downgrade. So Nifty was down 13% already. It fell another 11% nearly. The S&P was down 5%. It fell another 6.5%. You had the Nasdaq, which was down 4%. It fell another 8.5% back in 2011. And hence, right, now that's obviously it's got to be a question mark because we don't know. The Nifty and the changes coming into this event, the S&P and Nasdaq sort of changes, very strong returns coming into the downgrade of Fitch over the next 1 month or so. Who knows? Today, of course, we are down sharply But what will we fill those figures up with a month down the line? We don't know. Views differ, and I'll tell you there are two distinct schools of thought. One is sort of trend watchers, right? I mean, people who watch the trend, and it's a very simple argument. They say the markets sold off in 2011 after the downgrade because they were already down. The trend was down. So the way the market treats news flow in an uptrend and downtrend is different. I mean, in an uptrend, perhaps markets look through it. We see it every day with earnings, etc., etc. And on the other hand, in a downtrend, if you get bad news, the sell-off gets exacerbated. That's the first way to look at things. The second is the more skeptical viewpoint, which is simply the fact that the markets have done very well. Let's move this graphics along. That markets have done very well. Just to give you an example, they've done so well that the BSE, the NSE Small Cap Index, has not even had a 5% pullback even once since the rally began from the lows of 2020. I mean, you could say the similar thing for Nifty. You could say, actually not for the Nifty, but you could say similar thing for other indices. And they say, well, this could be an excuse for a bit of a pullback. So that's two viewpoints. I would personally, if you ask me, I would lean towards the first argument, which is, the state that the market is in, that tends to often determine how it takes a certain news flow, positive or negative. So that's, just looking at historical 2011 downgrade to see what the markets have done and what we may do from here on. We have Manish Singh from Crossbridge Capital and emerging equity markets strategist. Adrian Movat is also joining us on the phone line. Gentlemen, great to have both of you here. Thank you very much for your time. Adrian, so just want to, I hope you've been listening in. Your thoughts on, what I've put out in terms of the data and your reading of it. What happens next?
Look, I think this is an interesting wake-up call on the fiscal position in the United States. Part of the reason that we have a strong U.S. economy is that you've got strong government spending growth this year, some 3.2% in real terms. And so that's supporting the economy, but you can't keep that going. I think the other wake-up call is for bond investors. Now, I'm hearing a lot of people saying you should buy bonds at the moment because yields today look attractive. Well, yes, they do look attractive relative to the QE post-GFC world, when you had interest rates near to zero and central banks' balance sheet expanding and fiscal positions that were okay. We've now got a weak fiscal position, quantitative.
I think we've just
dropped
lost
the line.
that line with Adrian. So let's take the same question to Manish as well. Manish, that was very helpful data that Prashant put out. How we came into the downgrade in 2011 versus where we are after a fantastic equity run. Do you think markets are going to take this a little more seriously than just a one-day, two-day reaction?
Well, that's a big question. The market should take it seriously. But let me just qualify a bit. I heard Prashant's package, and it's very, very good. Now, one has to bear in mind that when we are talking about bond downgrade, so now that two rating agencies have downgraded, because S&P downgraded US in 2011, it is not a AAA because you need two of the three agencies. So there's only one AAA country now, Germany, a large country, right? So people have moved away from tracking AAA assets. So even if you look at it from bond investors' point of view, I don't think you will see a selling because it's not AAA. So I don't see that as a big problem. It is definitely a reminder to the US politicians and the US policymakers that they just can't continue on the path that they are in. Though I have to agree with Treasury Secretary Janet Yellen that this is very surprising, because if you look at the statement that Fitch put out when they did warn about the US position, and they said that they may have to downgrade the rating provided these three things happen, and those three things were significant and sustained rise in debt to GDP. Now that hasn't happened. Debt to GDP is where it is around 100%. And they also mentioned something called deterioration in governance quality. Now, a bipartisan approach to lift the debt ceiling until 2025 is not deterioration in governance quality. I mean, there is a unanimity in how the U.S. wants to work. And the third aspect was macroeconomic policy performance and prospects. I mean, U.S. has grown at 2.4% in Q2. If you look at Europe, Germany is in a recession, and Eurozone is growing at 0.3. So I don't think that, this downgrade is really I think the reason this downgrade has happened, I find it very puzzling. If you look at all the factors around, it should make people think. So if you take a 36,000 feet approach and see where you should be investing, I think emerging market bonds definitely are more attractive than developed market bonds for the reasons that Fitch and everyone has outlined, given the fiscal position, which could get worse. But that's the only thing I can draw from this. But it is not something which makes me think, you shouldn't hold U.S. asset or dollar assets or U.S. Treasury. On relative basis, in the developed market world, U.S. is definitely a far better economy in every way than any other economy in the Western world, I should say.
Manish, that point is well taken. We're back and connected with Adrian Mobad. Adrian, you were telling us, Manish was just highlighting how he's surprised, puzzled by Fitch's downgrade, and he doesn't expect meaningful selling of U.S. U.S. treasuries. But complete the point that you were earlier making.
Yes. So what I was making was I actually think U.S. Treasury yields are going to be moving higher. This is a secular story as we move away from the QE zero interest rate world that we had post the GFC. We're now in an environment where fiscal deficits are rising, net debt issuance, particularly with quantitative tightening, is accelerating, and U.S. inflation at the core level above 4% is still much higher than the Fed wants it to be, so short rates are likely to remain elevated. And so I think fair value for U.S. bonds is probably closer to 4.25 to 4.5. And that perhaps the Fitch story gets people just to relook at this story and think about the impact of moving to a more normal yield curve and a more normal level of long-term interest rates. But, I'd agree with the comment that on a relative basis, the U.S. economy is by far the most robust major economy.
No, absolutely. Take your point. So, Adrian, I think that's perhaps the right way to look at it, right? It shines the spotlight on the debt issues, right? Which is, we all know it's unsustainable. But when do we reach that point of unsustainability? No one knows, right? Perhaps not in a lifetime, so we don't have to bother. Maybe it kind of focuses the spotlight on that issue. But for stock markets, which have done so well, Adrian, what does this mean over the next 1 month, 2 months? Because we're sitting on some pretty strong gains across the world, in the US, here in India as well.
Yes, I mean, we're looking on strong gains from October lows. If you look at 12-month statistics for most equity markets, they don't look as strong. So I'd caution people a little bit in, extrapolating a strong move after a very, very weak 2022. But at a sector level, I would suggest that the rotation out of tech and growth stocks into near cyclicals like financials may accelerate as you get a slightly higher long-term discount rate, and that puts a little bit of pressure on growth. And if people start to extrapolate out yields remaining higher for longer, then that's good for the financials and then net interest income.
So, Adrian, just to expand on that point, if U.S. yields move higher, like you expect them to, where does that money go? What home will it look for? I mean, we have yields moving higher in Japan as well now, US. There's so much going on. What about flows into emerging markets like India?
Well, remember, you're asking about where the money goes. Well, we need more money to buy US bonds, which is a supply fact. The US government is issuing more debt because they're running a fiscal deficit, and the Federal Reserve balance sheet is being run off. So U.S. bonds will continue to have net inflows in them. The question is, at what price, at what yield do we need to move to for those flows to be attracted? So I don't think you can spin this as money goes somewhere else, because the fact of what Fitch is saying is more money does have to net flow into U.S. bonds.
Does that impact flows into a market like India? I mean, that's what we're really looking out for. It's been it's a fantastic rally in India, backed by very solid foreign investor liquidity.
Yes, but I would suggest the way this works is that bond yields grind higher rather than having significant bond market volatility, which was a characteristic of 2022. And if that's the case, I don't see it as a particular shock to risk assets in emerging markets, and that investors will be more focused on the domestic fundamentals in India, and perhaps also at the corporate level, are we seeing enough Indian companies, beating expectations or being a bit behind expectations? And the results season in India was a little bit more mixed. And I think that's probably going to still be the main debating factor or the main influencing factor for investors in India at this point in time.
Manish, Adrian, thank you very much for joining us and giving your insights, sharing them on this important issue for the markets. Get into a break. On the other side, full tilt on the domestic markets. Prakash Diwan, Srinivas Rao Ravuri will join in on the other side.
Okay, there's some attempt at a recovery. Remember when we started the show, we were down 300 points. Now we're down 50 points. You can first sign of, a fight back. Pull up Reliance, intraday, ICICI Bank, even ITC to an extent. These are the big boys that are trying to pick up the pieces now. There you see a little bit of a lift off from the lows of the day. ICICI Bank, ITC, and there is also Reliance in the mix. Those are the three. But beyond the large cap screen, there's a lot of pressure on mid caps. There's no taking away from that. Just take a look at a stock like Redington, which is down almost 10% after numbers. So plenty of pressure on mid caps. We are putting the spotlight now on one such mid cap, which is moving, but not because of earnings, because of other news. Sula Vineyards, lots of selling on the stock today. It's down almost 7%. Surabhi Sataria is here with the details. Surabhi, now we know, I guess the trigger here was this excise demand of over 100 crore rupees, right, from Sula?
That's correct. So they have received an excise duty notice of 116 crores from the Maharashtra Excise Department. Now the company did say in its exchange notification that there's no bearing on the operations or any ongoing activity. But the cash on the books of Sula for FY23 indicates that they have a cash of 115 crores. So we'll need more clarity on what is the actual cash outflow for this excise duty. Apart from that, there is one other concern for this company which is not related to this excise duty notification, but it is the potential withdrawal of WIPS incentive. WIPS is the wine industry promotion scheme incentive, which is by the Maharashtra government to encourage wine production. Now this incentive is provided by a way of refund of 80% of the VAT paid on the sale of wine, which is within the state, which is the Maharashtra state. Now Kotak Institutional Equities back in June 2023 had written on this. They said that this subsidy accounts for 28% of this company's EBITDA in FY23. They are not too worried about the withdrawal as long as it is done in a phased manner over 5 to 6 years. So apart from the excise duty, there is this concern for this stock, but they are two completely separate issues.
Okay, all right. Thanks a lot for that, Surabhi. Prakash Diwan is joining in. Hi, Prakash. Well, the stock is getting knocked back because of the reasons that Surabhi just mentioned. How would you approach it? I mean, it's done very, very well, but clearly there is some money being taken off the table.
No, absolutely, Nigel. So, the run-up post the IPO has been spectacular. And it's definitely to its advantage. It has the premium valuation that it gets accorded because of the leader in that space. But remember, the market that it caters to is very, very niche. You're talking about just about a 2% of the overall alcohol business industry going their way. And within that, they compete with a lot of imported stuff and, new challengers that keep on coming. So it's always going to be something which they will have to challenge themselves again and stand out as winners. So it's going to be operationally quite intense, from the business perspective. Valuations will keep on, wavering depending on what expectations people set from the news flow on the company. But my sense is the regulatory overhang is still very large. Let's face it, the WIPS is meant to support smaller businesses, new startups in that sector, not somebody who's the biggest and the most mature. So, at some point that could kind of become a little bit of a negative headwind. And apart from that, it's only competitive intensity that can pull them down. So from that perspective, you would only buy it at lower valuation. I prefer the bear market to play the alco-wave segment. I mean, you have far better vehicles, and we've discussed that in the past. So Sula at this stage, at this price, probably is a bit too pricey.
Prakash, we all thought real estate is in a super cycle. The Mumbai registrations kept going up month after month. But looking at Godrej Properties numbers, it's hit a bit of a speed bump. So just to refresh everyone's memory, in Q1, Godrej Properties total area sold was down 20% year on year. Booking value was down 11%, though the collections are up 26% year on year, but down 49% quarter on quarter. So it's not bad, but it's not a robust set of numbers. How would you view Godrej Properties and the rest of the real estate pack? Or do you think Godrej is a bit of a one-off?
No, Rima, I think it's a very valid point that you brought up. Real estate is very specific to location, very specific to the price point and segments that companies cater to. I mean, unfortunately, you cannot kind of, paint all of that in a single stroke of brush. This particular set of numbers from Godrej tells you that their projects, which are in multiple locations, of course, haven't done well from the JDA model because of the execution that takes much longer. They've gone into larger projects. If you see the average inventory in any of the Godrej projects, it's much higher than probably than other competitors. So execution takes much longer. The pricing is always going to be much more softer as compared to a smaller inventory project. And then remember, your cash flows are staggered over a longish period of time. So all of that has kind of impacted them, though they have quality deliveries and all that. In that space, if you have to look at, you'll still have to focus on pick something out of Delhi. Delhi or NCR at large. The reason being the opportunities out there for the scale that they are seeing in terms of absorption of premium residential real estate is far more superior than even Bangalore or Mumbai. Though we have relative registration incrementally going up in Mumbai, I don't think it's still so significant, and it's fragmented with so many players in the fray. But I think you'll have to look at Delhi, and that's real estate within Delhi is the pocket that's probably still promising. And you could find some names out there if you go, and then that's where your risk reward will probably be more favorable.
Okay, all right. Well, thanks a lot, Prakash, for stopping by and filling us in with all of those details and the quick analysis on a couple of stocks. By the way, the bulls are trying to fight back a little bit. So from the lows of the day, we have come off close to around 60 points or thereabouts. ICICI Bank, well, that's one of the stocks that's come off. But ITC, that's the one that's been seeing some kind of selling pressure. But that's fighting back as we speak. So a couple of these heavier weights, they are fighting back, and that explains why the Nifty has seen some bit of recovery. Currently, we're holding above that 19,500 odd mark. But it's a good time to move to our special segment, D-Street Chatter. Nimesh, what are you picking up? I mean, clearly the Fitch, crude, you have the stronger dollar. They've spooked the bulls today.
It spooked the bulls, and I guess it's healthy as well, right? And if you look at the markets today, I guess all the excessive is getting cleaned out. So that's, in a way, that's healthy. So that's overall feedback. I guess you rightly pointed out 19,450 is acting as a very strong support on the Nifty in today's state. So that needs to be whether that is defended by the bulls in today's trading session. But broadly, I'm told from a near-term perspective, 19,200 is another important level to track on the downside. That needs to be protected for this momentum to continue. So that's the broad technical feedback. From a flow point of view, though, I guess there is no panic selling, so to speak. That's a big takeaway, is what I've understood from all the dealers that I've spoken to. Yes, they have been net sellers for the last many days, but there is no large selling, is what I understand from the larger institutions. I guess as I explained earlier, it's largely the unwinding which is putting pressure on a lot of stocks, whether it's the F&O stocks or in the cash market as well. Again, the sense I'm getting is maybe you'll have to see for the next couple of days how the other global markets react to this US news. But broadly, 19,200 seems to be a level to watch on the downside from a technical perspective.
Well, that's right. And we have a bit of a bounce from the day as well. Nimesh, earlier today we were highlighting that Vedanta is trading at a discount in the futures. But so that's, I think, one of your stocks on your radar. Yeah. But tell us the list. What else are you picking up?
Sure, I'll talk about Vedanta. But before that, the first stock on my list is GAIL. That stock is under pressure today, and largely on back of strong sell flows at a leading FID. So after yesterday's disappointment numbers, we've seen some bit of selling coming back in Vedanta into this. So that's the first one. The second stock is RailTel. Again, the stock is under pressure today, but we've seen a huge move in that stock in the last many days. Even yesterday, the stock was buzzing in trade. And I guess for the last couple of days, there is very strong buying at the HNI. So looks like some larger HNIs, some family offices are quite bullish on RailTel, and they've been buying as well in this market. So that's the second one. The third stock is Vedanta. Nigel spoke about F&O trading at a discount, and the large part of it could be because there is a strong buzz or indication of a large block deal coming in Vedanta very soon. So that's something to track in Vedanta going forward. And the last stock is Suzlon. Again, with the current market, even that stock is under pressure today, down 4%. But for the last 2 days, there is very strong buying, is what I understand from FIDs. So it looks like some larger FIs have started participating on the buy side in Suzlon at these levels. And of course, in Suzlon, the next big trigger to watch will be the fundraising, which might get announced very soon. So that's the trigger on Suzlon and why some larger FIs are buying into that stock.
Okay, all right, Nimesh, thanks a lot for that. Well, for the time being, though, we'll slip into a short break. When you come back, as always, we'll give you some buy or sell trades. Stay with us.
Well, it's a commendable effort, you'd have to say, by the bulls. We are back above 19,500 for what it's worth. So there you go. The first semblance of some sort of a pullback, some fight back, that is seen on the screen. 19,511. Mitesh, what's the advice now in terms of any index trades, or otherwise if you're looking at individual stocks?
I think on the index, as I said, I think I would still consider selling, but at slightly higher levels. I think closer to about 19,600, 580 zones. On the stock side, I have one buy and one sell. The overall structure is mildly on the weak side, but then at lower levels, you have some key support areas closer to about 19,380, 400 zones. So we got a bounce back from 19,420 today. So I think around those levels, you will see some short covering happen. It is still not a declining or a downtrending market, therefore I think it will be slightly choppy, corrective kind of a movement. And I have a BTST or a buy side trade on Berger Paints, which I would recommend taking a BTST with the stop loss 701 for targets of 720. And HDFC Bank is a negative trade on the sell side, so STBT with a stop at 1647 for targets of 1620.
Okay, Mitesh, we'll have you back. Thank you very much for that quick update. 19,500 plus on the Nifty. So yes, as Surabhi said, some semblance of a bit of a pullback is what we have. Srinivas Rao Raviri is Chief Investment Officer at PGIM India Mutual Fund, and he's with us to take some questions. Srinivas, good to have you with us here. Good afternoon. They say buy when there is blood on the streets. I mean, I think there's only a hint of blood. I mean, it's very a drop, maybe half a drop. But are you buying anything? What are you doing? And how are you looking at the entire picture?
Yeah, good afternoon, and thank you for having me here. I am pleasantly surprised and also, but happy to see this, I will not say blood correction. I think this is much warranted. I've been waiting for, I think most of us are waiting for quite some time. Though as a fund managers, we all will be happy to see market going up and investors seeing their NAVs giving good returns. But I think what we've seen in the last 3-4 months is a bit of an exuberance, I would say. If you see, let's say the 3 months returns, large cap versus mid cap versus small cap, large cap is 15%, whereas small cap was 30%. So I think there is clearly a bit of excesses that got into the markets in the last few months, led by we've seen every month FIs investing almost $3-4 billion. It's been a fantastic rally led by that. And B, I think, which is also equally important, which is what makes us to remain positive on the long term. I'm saying Indian economy is doing extremely well, and same is reflected in the corporate earnings also. Right now, about 70% of the Nifty companies have delivered result for the first quarter. And if you see the numbers, the top line growth is about 8%, whereas the EBITDA growth is upwards of 30% and profit growth is upwards of 40%. There is a base effect that one need to take into account. But overall, 15% earnings growth for the current year, it seems to be very much doable, and companies have surprised positively versus the expectations. So the underlying economy is doing well, but when you see the kind of rally that we've seen in the last few weeks, I would say a correction like this is most welcome.
Srinivas, you said there are excesses, there are signs of exuberance in the market. Have you used this rally to trim your holding in any sector, stocks, themes?
Yes, definitely. Wherever we saw stocks, I would say rallying up a lot and going out of what we look at as a fair value, we have reduced exposure or pruned exposure to book profits. That's what we are supposed to do, Rima.
Is in which sectors or stocks have you pruned your exposure?
So I would say, consumer and industrials. I think these are the two sectors where we have seen, we have looked at reducing exposure, though very, very reluctantly, because, especially the capital goods or the industrial sector, we are clearly seeing the revival of capex cycle. The manufacturing sector will do well. But as a fund manager, our job is not just to buy companies that will do well, but we also have to buy these companies at a fair prices or below fair value. Even though the next 2-3 year outlook is very, very positive, but when you see the valuations, one simple metric, price to earning, all these companies are now trading above 50 times 1 year forward earnings. So I think that is one simple metric one can keep in mind. So if next 2 years growth is already factored in, one should actually be cautious and prune exposures. I think we have seen, in the last 2 years, chemicals is one classic example when everybody got bullish, excited. But if you see last 1 year, returns have been very, very meager. Same is the case with, let's say, manufacturing, electronic manufacturing. So I think growth is important, but at the same time, when you see, this is what market tends to do. When you see that things are going a bit on the excessive side, we need to reduce exposure. That's what we've been doing.
Okay, got that. So that's where you're reducing exposure. But tell us about some themes where you're willing to go in as well. Anything interesting that's crossed your radar? I mean, we were speaking with some of these EMS companies earlier. Defense has been doing exceedingly well. There are a lot of new listings as well. What's new on the mind, Srinivas?
Unfortunately, very few in terms of new additions, Surbi. I think financials and pharma, I think these two is what I've been positive and holding on for some time. So remain so even as of today in the international mandate that I manage right now. So I think pharma, especially, we've seen a very strong rebound in the US generic markets. But in terms of new names, I would say, given the way market has behaved in the last 2 months, been cagey about adding new names at this point of time.
Just a quick one, Srinivas. Aren't these entire capex theme also very expensive now?
Yes, I think, see, when I'm having let's say, even a 12 to 18 months view, I would say it is expensive. But let's say if you want to say 3 year, 4 year view, maybe they are not expensive. But I think the moment you look at 3, 5 years and trying to extrapolate what has happened in the last, 6 months, 12 months to next 2, 3 years, I think the margin of safety is definitely much lower. So I think that is where, risk reward is not in the favor of investors to get in whenever, market is trying to factor in 3, 4 years growth ahead. I think my style doesn't suit that, so I would like to stay away.
Srinivas, thank you very much for joining in. Look forward to another conversation very soon. But that's the view coming in from PGIM. A bit of excess, a bit of exuberance in the market, and they have reluctantly pruned down their exposure to industrials and the consumer space. Let me quickly talk about Bharti. Bharti will be reporting numbers. Numbers come out tomorrow post-market hours. The street is working with a consolidated top-line growth of about 1.5% on a quarter-on-quarter basis. Now, Bharti's revenues are a mix of their India mobile business, the Africa business. They have a homes business where they have the D2H connection, etc. They also have an enterprise business which caters to the data center, etc. The Airtel Africa numbers are out, and they've been a beat. Both on the top line and on the margins, Airtel Africa positively surprised the street. So the question is there a possibility that the consolidated revenues and margins will see a beat? Because these numbers, expectations were set prior to Airtel Africa's numbers, which got released a couple of days back. The India mobile revenue growth is seen up about 3.5%, which will be driven by a 2.5% increase in the subscriber addition and about a 1% increase in the ARPU. Now, the subscriber numbers for April and May are already out by the TRAI. So we have a fair sense of what the subscriber growth is going to be. The street is going to track the ARPU increment. Because if you remember, in the beginning of the year, the company started upping the entry-level prepaid tariffs. The lower-level entry-level tariffs were removed, and if you had to buy the cheapest plan, you had to spend as much as 150 rupees. So that's going to reflect in the ARPUs in the current quarter. So that's about the India business. Margins on a consolidated basis seen at 52%, and the bottom line, which typically varies depending on their interest cost, forex, as well as depreciation, according to the poll, is closer to 2,700 crore rupees.
Okay, so that's one big number we have to watch out for. Let's see how Bharti delivers. The other one is Sun Pharma. Considering pharma boys have really lit up the street this earnings season. Ekta is with us. So can Sun Pharma continue with the good times, Ekta?
Well, all eyes will be on the specialty business, which I'll just come to in a second. But the revenue is expected to grow around 8-odd%. Margins are probably expected to come in at around 24-25%. And profit of around 2,090 odd crores and expected to be flat on a year-on-year basis. Now, expectations are high single-digit growth. The range, like I mentioned, the range is anywhere between 6 to 9 odd %. The growth is expected to be led by the specialty portfolio in the US plus other markets. Now, specialty portfolio is basically the psoriasis drug, Ilumya, acne drug, Winlevi, eye drug, Sequoia. And Q4, the global specialty sales were up 28% year-on-year to $244 million. It is also expected to be supported by Revlimid generic sales in the US markets. It's the cancer drug. Estimates are for the US as a whole in terms of the business is $440 to $465 million. This is versus $430 million on a Q-on-Q basis. So there is expected to be an improvement. Remember, last quarter, the US business was higher than expectations. Domestic formulations estimated to grow between 8 to 10 odd %. Margins are expected to be aided by the specialty business, but could be offset by higher R&D spend as well as remediation charges because of the issues that they have, for example, at the Halol facility. Now, commentary with regards to the Halol import alert, Mohali consent decree, which is given by the US FDA, specialty portfolio sales, when will they probably hit $1 billion, US price pressure, and the NDA filing of an alopecia drug by a company, Concert Pharma, which they've acquired recently, would be something that the street would watch out for.
Okay, all right, got that, Ekta. Thank you very much for the update on Sun Pharma. That's the earning to look out for tomorrow. Quick break on that note, and then we get chatting with Anand Tandon, talk about today's fall and now what one should keep in mind going forward.
Welcome back. We've come off the low point of the day and a few stocks are fighting back for the Nifty. You have Tech Mahindra, post those numbers, the stock saw a negative reaction, but after that, all the dips are being bought into on that stock. So just keep an eye out on the intraday chart. You have HUL as well, the other, high pedigree name in there that's bouncing back as we speak. The intraday chart tells you the picture out there. And Asian Paints. So all these three stocks, they have done quite well. From the broader markets, though, you have AU Small Finance that's bucking the trend. So a couple of these stocks are seeing a good amount of buying from lower levels. We have market expert Anand Tandon who joins us on the show. Hi Anand, good afternoon. Thanks so much for joining in. Tech Mahindra's numbers, very disappointing. But those dips are getting bought into. Clearly the street wants to look ahead and they believe things will improve from here on. What's your view?
Eventually they will improve, but I don't see any hurry to be buying Tech Mahindra. That is one of the more weaker stocks in the IT portfolio overall. The only thing going positive for that is the fact that because of its specialization in telecom and the rollout that is expected across the world for 5G, you do expect to see some incremental flows in the telecom business, which they may be able to leverage off. But their execution has been relatively weak, and not just only in this quarter. So I would think that whenever the IT businesses were to turn, you may be better off looking at those where there is a stronger execution track record.
The thing about Tech Mahindra is also the headroom is so much more, right? Their margins are at 11-12%, while peers, companies of similar size, I'm not talking about a TCS or Infosys, but companies of a similar size like in HCL Tech or LTI Mindtree, their margins are at 17 to 18%. So the street is betting that perhaps there is some low-hanging fruit which is available with Tech Mahindra to improve their margins from the current levels of 11-12% and get it up to the industry average of 17-18% for those companies. Anand, afternoon. I remember the last time you were saying it's very hard to find companies where the valuations are a bit attractive, right? Because everything has run up so much. How are you feeling about the markets now? Have you been purchasing, buying anything in the markets right now? If yes, could you elaborate a bit?
So there aren't, as I said, too many stocks in the front line that you could look at which give you any degree of comfort. If you have to be in the portfolio, in the business, obviously you need to be invested. So the question is, what are you going to be buying? Incrementally, I would continue to argue that something like an HDFC Bank continues to look relatively cheap, both on a historic basis as well as in terms of the future. Trading at around 2.5, 2.7 times book value, and still growing. Its credit book by 17-18%. ROE is fairly strong, probably one of the best in the sector. There is no particular reason why it should not be moving up when the rest of the sector is doing reasonably well. So aside from stocks like an HDFC, maybe, we've already seen a recent run up in, for example, some of the power stocks. That is, the utilities was the other place that I thought there was significant value. Even from a dividend yield perspective, many of those companies are fairly attractively priced. Power Grid, for example, has not done particularly a great quarter. But if you look at what it is projected to do over the next few quarters and the fact that, much of it is regulatory capital, I think you will continue to get 16-17% kind of ROE coming through in that business. And that will give you, again, a fairly strong dividend yield. So you have to be a little selective in terms of looking for specific names rather than, sectoral bets. But most of the current flavor of the season, which is, for example, capital goods, autos and so on, I think they've pretty much run their course.
Autos and capital goods have run their course. Got that. Anand, so finally, power had a fantastic run. I mean, a stock like NTPC, up until today, was doing exceedingly well. What did you make of that move? And would this be an area that interests you at all?
Well, as I said, I was actually fairly bullish on that. And frankly, I do have a position in NTPC personally for a fairly long time now, over 2 years. But the point is that, it is finally a utility and, there is some regulatory capital which will attract the growth. So, as I said, for Power Grid, similar argument works for NTPC as well. Over the next few years, you will see its character changing quite dramatically from being mostly coal-driven facility to being a company which also has renewables. It also has a whole lot of other, sources of, should have a diversified base in terms of fuel. And it remains obviously the biggest that you have in the sector, still reasonably attractively priced, but much of it has obviously been given up over the last few days of price movement. So from here on, incrementally, you want to be a little more careful going in. But essentially, it is the fact, my base case remains that energy is something that will be moving up in terms of prices, and you have to find ways to play for it.
Okay. All right, Anand, got that. Thank you very much for joining in today and giving us your view on several sectors and stocks. As we're closing out, by the way, I was checking foreign screens once again. So Europe is still reeling under losses, 1.5%. Futures on Wall Street are down anywhere between 0.8% on the S&P 500, over 1% on NASDAQ. Let's see. The hope is going to be that we have actually, preempted the Wall Street selling, and that's what the bulls will go in with, that hopefully we've seen this today and then we'll have some stability overnight from the US. But for what it's worth, there was a pullback, a 100-point pullback, no less, from the lows of the day. So instead of a 300-point cut, the Nifty is now looking at a 200-point cut. But still, cut nonetheless. Hero MotoCorp, Tata Steel, Tata Motors, these are some of the weakest stocks. NTPC losing a lot of those gains that it saw earlier in July. Eicher, these are some of the big names on the way down. SBI, L&T, actually, I'll have to say it's just completely red. I mean, only few stocks, Divis and Nestle, are the two ones that have managed to put on at least a 1% gain. Otherwise, it was a down day. We didn't have too many stocks on the upside. It's just the ones that were falling stopped falling as much. And that is what resulted in that 100-point pullback.
Well, HUL, Asian Paints and Tech Mahindra deserve mention for the kind of recovery they saw in the last 10 minutes. So HUL, Asian Paints are ending with a gain of more than about 0.5%, and Tech Mahindra, with the recovery, has erased all its post-earning losses. Remember, post the earnings, Tech Mahindra fell, but with the up move that we've seen over the last few days, Tech Mahindra is back to where it was prior to that. The Nifty Bank has recovered close to about 300 points from the day's low. It's still ending down 550, 600 points, but significantly off the day's low. A quick run through of some of the big losers. Strides Pharma post numbers down 7%, so that stock was weak. You had sharp cuts on Piramal Enterprises, Z Entertainment, JSPL, BHEL. These are stocks with cuts of anywhere between 4 to 5%. On the gaining side, PVR Inox manages to buck the trend. That's up. And you had strength in Loris and Divis Laboratory and Marico and Nestle.
I wish I could turn my screen around and show you this chart. But basically, what the market has done today, guys, is there's basically a rising trend line from the lows of March. I'm not talking, say March nowadays, people assume 2020, not 2020. That you'd have to go back a long way, but March 2023, that low basically was 16,800. Right? I mean, we're still about 3,000 points above it. So from 16,800, there's a rising trend line, never broken. The one touch point in June of 2023. Today, we've basically touched that. There's a touch and then there is a bounce off that one. So I think that remains the one to watch. That basically is the day's low today. So 19,423. Maybe tomorrow morning we can put the chart out, and that'll do the talking in terms of what this looks like. But 200 points could have been 300, so there was a bit of a bounce. 19,500 plus is where the market closes. It's a wrap from all of us here. Thanks very much for staying with us, but don't go anywhere. Our Wednesday special, Mad About Markets, comes up next. Stay tuned.